Another way to look at the randomness in the marketplace is look at how these sectors did on a bar graph on each year going back to 2008. Remember the disaster year. Our investment philosophy is not to make any bets, to assume that there's randomness, and to make sure our clients are exposed to all parts of the market. Any attempts to dance your assets, your wealth, in and out of these markets can end up to be maddening. Going back to 2008, the terrible year, you can see that the average return, the dashed red line of everything, was down about 30%. The only asset that was up that year was bonds and gold. Everything else lost money. Our Blue Ocean Portfolios clients were down about 30%. However, the most important thing to do when you set these investment policies is stick with them. Don't freak out because of the outcomes. Remember, yesterday's losers can easily be tomorrow's winners and vice versa. Because if you look at 2008, many people said, I want to go into bonds. I'm sick of this volatility in the stock market. But what happened in 2009? The only loser was bonds. The people who changed their allocation were completely wrong. They were chasing outcomes. They were running away from the fear, going right in the place they shouldn't have gone. The only asset class that lost money in 2009 was bonds. Remember, folks, past performance means nothing. You have to ignore it because you'll get fooled into chasing outcomes. And 2010 was another unpredictable year. The outcomes were completely random and unpredictable. The average of all assets, the way we allocate for our Blue Ocean Portfolios, was up around 16%. That doesn't mean that there's any predictability what's going to happen. It means that we don't know what's going to happen in next year. In 2011, we saw the markets in disarray. We saw a significant drop in emerging markets. Gold was still strong. Bonds came back very strong. But the average return of all these groups was actually a negative in 2011 because the commodity market, the oil market, the European markets, the small stock market in the United States was all down. The large stocks won, but not the small ones. But again, the average of everything was down about 1 or 2%. In 2012, though, everything changed again. The losers of 2011 became the winners in 2012. And across the board, the average of everything was around 12%. In 2013, more unpredictability. Gold, for the first time in 12 years, is down over 25%. The average return on all assets, though, is up close to 18. Does this mean you shouldn't own gold or commodities? No, it just is a consequence of diversification, is that you don't know what the winners or losers are going to be. I assure you in 2014, there's not a person out there that you can pay that's going to tell you where the best place to put your money. One of our clients actually said, Jim, I will pay you more if you can get a better return. I said, well, that's like paying more for winning lottery tickets. Of course you would pay more for a winning lottery ticket. And future outcomes are very similar to sporting events or lottery drawings. No matter what happened yesterday has nothing to do with what's going to happen tomorrow.